There's really four things that I'm looking for when I look for stocks. I'm looking for a durable business that passes what Buffett would call the 10-year test. You can close your eyes and look out 10 years and understand what the company's doing or visualize what the company's doing. And then I want to have a company that's producing high returns on capital. That's number two. And then number three would be capital allocation, sort of a management test. And then the fourth is valuation. The nice thing about share buybacks is if you think the stock is cheap, then you're sort of getting a double dip. I mean, you're getting that buyback yield plus the potential for the multiple to go up. I'm more of a methodical. I take my time. I'm a slow learner. I like to do deep work, a lot of research on the industry. I really try to understand what I'm doing, and so that takes a lot of time for me. So Walmart never made free cash flow until the late 90s because they were always pouring all of their operating cash flow back into new store growth and then some, taking on debt to further that growth.
Hi, I'm Steve Clapham. Welcome to the Behind the Balance Sheet podcast, where we meet leading investors and commentators and educate ourselves about the world of investing and the world at large. Our mission is to remove some of the mystique around investing and improve our understanding of what makes a successful investment or indeed an unsuccessful one. Our goal is to inform, educate, and entertain. We hope you enjoy this and every episode.
Behind the Balance Sheet and affiliates and podcast guests may own shares or have an economic interest in securities discussed in this podcast, which is aired for your education and entertainment only. Nothing in this podcast should be construed as investment advice or relied upon for investment decisions. Always do your own research.
This episode is brought to you by AlphaSense, the #1 rated financial research solution by G2. I have started using the platform myself, and now I can access all the company documents, the earnings calls, and the expert network call transcripts in one place. With generative AI-powered summarization and chat features, AlphaSense delivers instant, accurate insights into what's driving your investment universe. I was talking to the manager of one of the UK's biggest tech funds, and I asked him, how do you use AI? And he told me he'd listened to the Salesforce earnings call the previous night, and he was concerned about the growth in its marketing cloud business. He couldn't remember the size of the revenues, and he simply asked AlphaSense for the answer, rather than trawling through the 10K. Enhance your financial research today. Visit alphasense.com. That's alpha, ALPHA -sense.com. This month in the show, it's John Huber of Sabre Capital Management. I've read John's blog, Base Hit Investing, for years, and I've really enjoyed his writing. A bit like Chris Paviz in episode 12, I liked what he wrote, so thought he would make an interesting guest. And indeed, that was true both times. John runs a small fund which effectively is his family office, and outsiders can participate in it with a fee structure similar to the old Buffett partnership. We talk about John's 3 engines for growth, which is his model for investment appreciation, why he thinks a 6 to 10% revenue growth rate is a sweet spot, how he assesses stocks on a 10-year time frame, how his thinking about Alphabet has moved on in the 5 years since his talk at Google, the similarities between long-distance running and investing, and why he sees value in US small caps. I hope you enjoy my conversation with John Huber. John, listen, welcome to the podcast. I'm delighted to talk to you. I've been reading your blog for some years, probably back, might be 10 years now, but I know you always wanted to be an investor, but you went into real estate first. Was that partly a way of building the capital, or have there been other advantages? You own a couple of home builders, for example, now.
Yeah, it was exactly that. It was a way to try to build some capital. I started reading about Warren Buffett, like a lot of investors, in college, and started reading some of his biographies, which of course led me to the Buffett letters, the Berkshire Hathaway letters, and the partnership letters. Particularly interested me just because it was, that was more along the lines of what we would call like a hedge fund today. Buffett called it a partnership. And I just looked at it as, wow, this is a really great way to manage capital. Um, you sort of align yourself with your limited partners, your investors, and you make money if they do well, type of thing. And so I really admired the structure that he set up. And early on, I kind of thought, wow, maybe I could do something like that down the road. Real estate for me, I was very interested in it at the time. And I was, I've always been interested in business and investing and entrepreneurialism, and wanted to pursue that as a way to leverage my very limited resources at that time. And a partner and I went around buying. It was one of those things where we were in the right place, right time. It was the very beginning of the um, global financial crisis, and the foreclosure boom was really in 2007, and that's when we were able to go around to different banks and acquire single family homes. Primarily at the beginning is what we focused on, and we were able to buy properties at significant discounts to their underlying value, and we would fix them up, lease them, hold them for cash flow, and kind of recycle that process over and over again. And so we did that as a way to leverage the capital and build some capital so that I could start a fund down the road. And so that was sort of a means to an end.
And I really enjoyed your blog, and you've got this trick of saying there's always three things, which reminded me, when I was on the south side, when you spoke at the morning meeting, the salesman could never capture more than three things. So it was always there, and I think it's actually quite true. There's always three things about a stock. But you talked about there being three drivers to make money from an investment: growth in the business, change in the valuation, and a change in the number of shares. And you've talked, I think, about how some, for example, growth investors overemphasize the growth part, and a few value investors place a lot of emphasis on the second in the low multiple stocks. But not enough people pay enough attention to the third part, buying cash generative businesses that can buy back stock, especially lowly rated ones, which is very similar to what David Einhorn's doing right now. He thinks that, it's not much point in buying a stock and hoping somebody else will come along, another institution will buy it. You're better to buy something that the company will buy. Can you just talk about this? And you also said that you found a sweet spot on the growth side between 6 and 20%. You talk about why that is and how you approach all this.
Sure. Yeah, we can talk. I wrote a post called Growth Traps, which was sort of inspired by the book John Neff on investing. And, we can talk about that in a minute, but just to answer the first part of that question on the three engines is what I call that. Yeah, I think it's interesting. And you brought up David Einhorn. He's been vocal about this in a few of his letters, I think, in recent years about, he invested in this company called Consol Energy, which is, I think, one of the stocks that he uses as an example here. But that stock, roughly speaking, might trade at a 20% free cash flow yield. And his view is, hey, we don't need. He doesn't explicitly say this in terms of laying out the three engines, but he's basically saying we don't need growth. We don't need even a change in the PE multiple. We're getting a 20% free cash flow yield. In that case, they're using most of the free cash flow to buy back shares. So you're getting a buyback yield of 20%. So you don't need the other two engines, was his point there. My point in kind of outlining those three drivers is just to get people to think about how a stock goes up or down. And I think in recent years, so many people have focused on that first engine, which is the growth engine. And growth over the long run is obviously critical to a business's success and a stock success. But surprisingly, you don't need that much growth. Some of the best stocks of all time have not been these huge, fast growers. I mean, there are a few like Amazon and Netflix and others, but a lot of them have been just steady Eddie, 6, 8, 10% growers, like an O'Reilly Auto Parts, that uses its free cash flow to buy back shares. And so you get some contribution from growth. Maybe you get 8% from growth. Maybe you get, a little bit from a valuation increase, but you don't even need that much, because the secret sauce there is if a stock trades at 10 times earnings, and let's just, for sake of argument, assume that the earnings are cash earnings, 10 times free cash flow, they're going to be able to buy back a lot of their shares over time. And so that's how you get these high teen type long-term returns. And the secret there is some of these stocks have been, in my opinion, perennially undervalued just simply because they're not fast growers and they don't attract a lot of attention, at least in the early years. I mean, everybody knows about AutoZone and O'Reilly now, and NVR, but for years and years, those stocks traded at, 8, 10, 12% free cash flow yields. And that gave them the ability to buy back so much of their float. And so I do think you're seeing this in some other stocks right now that, perhaps a decade from now will be the next AutoZone or something. But I just think that is something that investors need to think about, all three of those, when you're thinking about the valuation of a company.
No, that's absolutely clear. And you mentioned John Neff and investing. I enjoyed that piece that you wrote. And funnily enough, it's a book that I read a year ago. One of my students, Will, recommended it. And it was a fantastic book because it really transports you into history, doesn't it?
Yeah, it's really interesting. I mean, I love books that are filled with like case studies, experiences of the investor. I don't read a lot of investing books anymore because you get to a certain point where you kind of feel like you've read most of the investing books, and now it's more about like, okay, let's read more about business specifically. But that is a really good investing book. Peter Cundall wrote a book. He's a Canadian investor that is very similar, where I think that book is called There's Always Something to Do. Both those books are interesting because they talk about actual investments and they go into case studies, and so you can learn a lot from reading through those. But yeah, John Neff, I mean, you were mentioning, Steve, the growth traps. A lot of people talk about value traps, and that's basically paying what appears to be a cheap price for a business that's eroding, and that's obviously a value trap. I think that the issue with growth traps or companies that are growing too fast, that's the opposite end of the spectrum. Companies can get themselves into trouble by trying to grow too fast, and that might mean making ill-advised capital expenditures, taking on too much debt, maybe hiring too many people, and that can cause a lot of growing pains. It can overburden the capital structure or overburden the operating structure of the business, and it can lead to a sort of a bloated cost structure, and that can lead to problems just like value traps. So that's sort of the point that John Neff made, is you be careful of companies. And Peter Lynch made the same point: be careful of companies that are growing too fast, because you can run into those sorts of problems. So he kind of had this like 20% is sort of a sort of a warning signal. Once you start growing above that, you need to be very cautious. And so that's just something to keep in mind. I've noticed throughout my own career as an investor, I've invested in companies and stocks across all different categories, but some of the best ones I've had have been in that I wouldn't even say 6 to 20. I would say more like 6 to 12 in terms of the percentage growth rates, coupled with a healthy buyback yield and perhaps a cheap price where you get the benefit of the multiple expansion. So you get all three of those working for you, and that can lead to a really nice long-term investment.
I think that it's just, if you grow above 20%, it's just a very difficult thing to manage, because just the growth of the overhead base and keeping up. I mean, I've seen this a number of times, and when you're growing at a fast pace, everything gets left behind.
It's
very, very difficult to manage.
Yeah, it's really hard to do that. Yeah, that's exactly right. We were talking about books, and one book I read maybe a year ago now is called Built from Scratch. And so I was doing some research on another company in that space, and Built from Scratch is about Home Depot. It's about the origin story of Home Depot, and they went through a period in the 80s where they went through a very tough time, and I wouldn't call it necessarily like an existential crisis or a near-death experience, but they did have some issues in the mid 80s. They made an acquisition, and what was happening is they were trying to grow their store count at an unnatural rate of growth. They were taking on debt to fund store growth, which was a similar playbook to what Walmart did for years and years. Walmart never made free cash flow until the late 90s because they were always pouring all of their operating cash flow back into new store growth and then some, taking on debt to further that growth, basically press on the accelerator a bit. And Home Depot was really pressing on the accelerator. And then they made an acquisition that caused some growing pains. And so Arthur Blank went to the board after that and said, look, we want you to put sort of a speed governor on our growth. We want to put in something in writing that says we cannot grow faster than 20%, or it might have been either 20 or 25%. But they were growing north of 30% for a while, and that's just a unit growth count that is really difficult to maintain.
Yeah, it's hard to manage. Yeah, you wrote a really good piece. I think it must be 10 years ago now on return on invested capital, and it's funny because people always talk about returns, but not many people understand them as well as you do. And you said you look for businesses that can produce high returns in capital, that can reinvest a large portion of earnings at similar high rates, run by good management who allocate the excess cash in a value-creating way, and preferably management with a stake in the business. They aren't that common, stocks with those four characteristics. I mean, how do you find them? Do you use a screening process as part of your process, or how do you do it?
I don't use a lot of screens. Occasionally I'll look at a screen just for fun, just to see what it might turn up. But usually whenever I do that, even it's more just a starting point to do some deeper work. So I've never been an investor that looks at a screen for like low PE stocks or anything like that. Yeah, how do you find them? That's the trick. I mean, there's no easy answer to that. It's sort of my method is I build a watch list. And so I have just a simple spreadsheet on, it's like a Google spreadsheet that tracks all of my companies that I've followed over the years. And then I slowly have, I sort of have two tabs on that list. One is my companies that I've already researched that I'm ready to invest in if the price is right. And then there's another list I call the farm team in baseball parlance, which is basically companies that I'm interested in learning more about. I'm in the process of researching. I'm not sure yet whether they'll make the cut for a future investment or not, but I'm evaluating them. And so, those can come from all different sources. They can come from a good friend of mine who recommends looking at a company, another investor I respect. It could come from reading an article in I get all these online trade magazines and stuff that get sent to my email, and I'm constantly reading through reading about different industries. I might read about a new company that I want to look at. Could be a book that I read. It's hard to pinpoint exactly where the ideas come from. It's just sort of a amalgamation of all of the work that you do during the day, and that stuff compounds over time. And so you build a list, and then I always have like a priority research list of try to focus my work on 2 or 3 companies at a time, but it's a long list of companies that I'm interested in reading about. So that's kind of
how do you decide? I mean, how do you decide how to prioritize that watch list? So you've got the back book of stocks that you would be interested in and spending time looking at. You don't know very much about them, and you've got, I don't know, 50 or 100 of those. Well, how do you decide what one comes to the top of the list? Is it a price driven thing, or?
Yeah, it's usually, I try to prioritize, you always want to be most efficient, right? And so I try to prioritize what I think is perhaps most actionable at the current moment. So, there's a lot of stocks that are, in my view, offer compelling value or potentially compelling value now, and you want to research those ones first. Having said that, I've never felt overly comfortable investing in situations where you have to act fast. I'm more of a methodical. I take my time. I'm a slow learner. I like to do deep work, a lot of research on the industry. I really try to understand what I'm doing, and so that takes a lot of time for me. So I'm never in a rush. And the reality is sometimes I miss things, because I don't act quickly, and that's just part of the game. But that's my method. Yeah, I think one thing in terms of trying to sort through ideas is, and this is something that I have evolved over time. You're always trying to get better as an investor. One of the things Nick Sleep said, who's an investor I really admire, I think he had a watch list one time that he wrote about this in one of his letters called High Quality Thinkers. And basically, what that was a management team that really understands capital allocation. And that is an element of there's really four things that I'm looking for when I look for stocks. I'm looking for a durable business that passes what Buffett would call the 10-year test. You can close your eyes and look out 10 years and understand what the company's doing or visualize what the company's doing. And then I want to have a company that's producing high returns on capital. That's number two. And then number three would be capital allocation, sort of a management test. And then the fourth is valuation. That third criteria has become more important to me personally, just because I've noticed from some of the investments that have worked, often have to do with management that's doing really rational things, not anything heroic, just rational things with the capital. And so, that's something that I'm spending more and more time thinking about. When I do see a management team that's doing smart things with capital, I try to flag that, make a note of it, follow up on it, try to get to
So
know
that
the
would
management.
typically be what somebody that you saw buying back shares.
Yeah, yeah. Buying back shares is a good one. I mean, that's the nice thing about share buybacks is if you think the stock is cheap, then you're sort of getting a double dip. I mean, you're getting that buyback yield plus the potential for the multiple to go up, right? So that's two of the three engines we spoke of. And if it's a good business earning good returns, then you're probably getting some growth as well. So yeah, any stock that you buy in theory, obviously you think it's a cheap stock, so you should hope that the company, if they have to the extent they have excess cash, should be buying back that stock as well. So buybacks are a huge factor for me. It's something I really like to see.
It's funny because obviously I've been a global investor, so there's a dichotomy between the US markets and other markets. And in other markets, buybacks aren't quite as fashionable, haven't been as popular. But in the US, I mean, I would have said that the majority of US companies that I've met with have talked about buybacks. I mean, I'm struggling, trying to remember all of the companies I've seen. I'm trying to remember anybody that said, "Oh no, we wouldn't buy back stock." They all say they would buy back stock. Maybe they aren't as aggressive in actually doing it, but it's a pretty popular thing in America. I mean, I wouldn't have thought that would be something that would necessarily distinguish many companies.
Yeah, it's a good point. I was reading some things. I came across something back in the 70s, and I was doing some work on a little bit of a research project unrelated to this topic, but it did occur to me that buybacks have not always been in vogue in corporate America,
No, no,
right? It's
no.
it's a relatively new phenomenon. I mean, there were companies like Henry Singleton at Teledyne. I think Cap
Mm.
Cities bought back a bunch of stock. Tom Murphy. I mean, there were companies that bought back shares, but they tended to do it using tender offers, or they tended to do it opportunistically, which honestly would be my preferred way to do it. Nowadays,
Yeah.
it's much more programmatic. Companies treat buybacks like they do a dividend. They just return capital to shareholders, which I don't even think that term is actually that accurate. It's more you're really buying out a partner when you're buying back shares. You're not returning capital to shareholders. You're buying out a partner. If you and I are partners with one other person, and we have three partners, and we want to buy out his share, then that's the buyback. You're sort of cashing out the partner, and obviously that's beneficial for the two of us as remaining shareholders of the business. But yeah, it hasn't always been that way. I think the important thing is looking at, I try to sift through what management says versus what they do. And that's just, you can look at
Yeah.
a 10-year chart of a share count and see, did this, they might talk all day about buybacks, but the share count's not moving. And so you can easily see if their words, match up with what they're actually doing.
Well, of course, you see quite a lot of companies where they're buying back stock, but in the open market, but they're giving them to the employees, and
Yeah.
behind the scenes, some of the options.
Yeah.
are quite staggering.
Right. And
And
that's the thing. I mean, that's why you want to look at the net share count reduction. And that's what I would call the buyback yield. If there is such a term, that's the term I use myself. But, you want to see like how much of that free cash are you getting as a shareholder
sure.
via a dividend or a net buyback, net of all the stock that you give away.
And do you think about that as sort of as a percentage of cash flows, or you just think, okay, they bought back 10% of their shares in the last 5 years, so the chances are I'm going to get more of that? Because the other issue, of course, is the price that you do it at.
Right.
And
Yeah.
I've found that companies aren't as disciplined as I would like often in buying back shares when things are bad and the shares are cheap.
Right. Yeah. Yeah. That is the case with most companies. Even companies I admire, you do notice that. And there's no good explanation that I can come up with for that other than human nature. I mean, when things are bad, people get scared, and people, it's just same with buying stocks. Nobody wants to buy stocks when times are tough and things look bleak and things are going to get worse in the next year. They only want to buy stocks after things look like they've sorted themselves out. And by then, of course, the stock's up 50%. And that's just the way it goes. So it is rare to find a management team that thinks that way. But even to the extent that buybacks are programmatic, like programmatic buybacks, where they're just sort of returning the cash flow, as they say, to shareholders, that still can be beneficial to you if you think the stock is cheap, undervalued, right?
Yeah.
And if you don't think
Of
the
course.
stock is undervalued and you don't want them to buy back shares, then perhaps you should consider, selling the stock and reinvesting into something that you do like. So,
No, absolutely.
yeah, consistent buybacks aren't a bad thing.
So no, I quite agree. So you did a talk at Google in 2018, but that must be quite a rare thing for an investor to do, because so well done you in getting the invite. But you said then that the culture, and more specifically the incredible talent of these firms, is somewhat underappreciated. Google has an unusually large number of employees who are not just super smart, but also very humble. There's an introspective focus on continuous improvement and long-term thinking that is very palpable there. You also made the point, which I thought was a very good one, that culture, employee talent, workplace satisfaction are three things that don't show up in the numbers, but they're extremely important to the long-term earning power of the company. So Google Alphabet now I think it's a 7% position in your fund based on the 13 Fs. I don't know if they're quite right. But I was just wondering, has your thinking changed at all in the intervening 5 years? You obviously like the company, right?
Yeah, I've always admired Google. I think it's a phenomenal company. I do think everything you just kind of rephrased from one of my old posts, I would agree with all of that. I think culture is, an undervalued. I thought that in 2018. I still think that today. I think one thing that has changed in the ensuing 6 years is some of those factors have become more appreciated in the market, I think.
Yeah.
In the mid teens, or like 2014, 2015, 2016, Google and Google traded under 15 times earnings. Apple traded at 8 times free cash flow, net of cash. Just incredible valuations for these companies. And I just felt like at those levels, the culture, those things that you just listed, the human capital component to these companies, that's the aspect that doesn't show up in the numbers, but has an incredible amount of value. And that's still obviously the case. It's just, I think more of that value now has been recognized, I should say, by the market. Now, I still think some of those stocks offer great value, but I was a shareholder of Apple for over 6 years, and Apple at 10 times earnings and Apple at 30 times earnings, those are two different things. I think those are two different investment profiles. So
yeah, no, absolutely.
Yeah. So I think, I just want to stress for anyone listening is, those things are all true. I mean, human capital is a critical component to business, especially in today's world, where so much value comes from intangible ideas. But you just have to be careful about what price you're paying for those things.
This episode is brought to you by AlphaSense, the #1 rated financial research solution by G2. I've started using the platform, and now I can access all the company documents, the earnings call transcripts, and the expert network call transcripts in one place. With generative AI-powered summarization and chat features, AlphaSense delivers instant, accurate insights into what's driving your investment universe. I was talking to the manager of one of the UK's biggest tech funds, and he loves AlphaSense. He uses it when seeing a new company to check what the key issues are. He uses the AlphaSense summary of the earnings call Q&As, and he can instantly identify the market's current key concerns. Visit alpha-sense.com, that's alpha-sense.com, to enhance your financial research today. Yeah, I mean, I couldn't agree more on Apple. I mean, I said, I think about a year ago, just over a year ago, I couldn't understand its valuation, and it's carried on going up. It just seems bizarre to me. I mean, to pay 30 times earnings for a company of that size, and, you know, just its sheer size must cap its ability to grow. And, you know, when it comes out with a new big thing being a $3,500 headset, you know, I'm scratching my head a bit. But on Google, I'm quite interested because the recent developments in AI, which I've just been writing my Substack, and I've been writing, I did it last year. I covered a whole bunch of banks' outlooks for the year. It was a very popular post. I've done it again. It was so long, I had to split it into two Substacks. And every bank is talking about AI, the opportunity in AI. Not one of them mentions a stock. You know, they say it's an opportunity. Well, I'm sure it is an opportunity. It's probably more likely to be an opportunity for the banks to cut costs than it is for some tech company to actually make a lot of money, I suspect. But in AI, that creates quite a significant uncertainty about Google's future. I mean, one outcome, and I think it's been an underappreciated possibility, because everybody sort of said, oh, Microsoft, OpenAI, they're the winners. And of course, Google have been doing this for quite a long time, and they're pretty smart people. And it could be that they're actually much more advanced than anybody else, and that they can cement and extend their position, because we don't know, we'll only see what they are showing us. But another potential outcome is the search box goes and the business model's undermined. And, you know, I own Alphabet, so full disclosure, I've got it in my personal portfolio, and I'm wondering at what point to exit it, because to me, there's such a, you know, a range of potential outcomes. I've got no ability to, I don't have a clue which one of those outcomes is going to be the right one. And the problem is that it might be a winner takes all kind of issue, that, you know, if you either have the best AI or you're left behind. I don't know enough about it, but just how do you? And I'm not expecting you to be an expert in AI. I'm just wondering how you factor that into your process.
Yeah, I mean, you know, Google's one of those investments that I think it's a business that has so many what I would call options on future potential, and some of that has to do, a lot of that has to do with the human capital that we were talking about before. And I felt the same way in 2018, which is around the time that I wrote that post that you referenced, and that is still the case today. I think what has changed is you know, the new developments with AI, the competitive picture. Microsoft might be getting into search. I mean, it does feel like there's more competition, and that is what capitalism is all about. And so I do think there are potential risks to that business, but I do think also that you know, one thing that Google has that very few companies in the world have is just a treasure trove, just an absolute mountain of data. And that data can be used in all kinds of different ways. And certainly it's above my pay grade to try to figure out how to use that data. That's what that's what they're doing. That, you know, and so we have a bunch of high quality thinkers there that I think will use that in productive ways. And, you know, I think of Google as like, I think Buffett actually referred to this company as sort of a royalty on the cost of goods sold, or the operating, the advertising budget of corporate America. And I think likely Google's position in digital advertising is extremely strong and likely to grow over time. Advertising tends to grow at nominal GDP rates, in some cases slightly above that, as economies develop and get stronger and companies have excess cash flow to spend on advertising. And so Google and a few other companies like Google will be in position to capitalize on that as more and more dollars continue to flow to digital advertising. So I think that position is still very strong. And then you have all these other things like cloud and AI and all kinds of other initiatives that may or may not develop in Google's favor, but they have such a cash generative machine going that I think has a strong moat, that I view those as uncertain potential upsides, but we'll see how some of those shake out.
Yeah, interesting. You said you make slow decisions, which I like. I mean, I was going to ask you, I mean, how long does it take you to research a stock? I know it varies, but just,
Yeah,
roughly on.
it's hard to say because sometimes I come across a stock. One of the recent investments we made last year, the from day one, I thought, wow, this is a great business, and it's a royalty company. It's a mineral rights royalty company, and that almost immediately I understood the situation. I felt like I understood what was happening. I had spent time researching that space for years before, so I understood the industry already. But in terms of the situation going on in that specific investment, I felt like I understood that very quickly. And one thing that's interesting, Steve, is I've noticed some of the best investments I have made over the years have been, in hindsight, it's easy to say this, but you do feel like almost like no-brainer type ideas where you're just so convicted right away that it makes sense. Now, I've spent a lot of time researching that particular investment over the ensuing months, but sometimes it really has you at hello. And so it varies. But I do spend a lot of time. I mean, sometimes I'll spend months researching an idea and never do anything with it. Other times I'll come across an idea where I don't buy the stock right away, but almost like I say, literally on day one or day two, I'm like, wow, this makes a lot of sense. And so sometimes those ideas come quickly.
No, I mean, I've taken positions in something, usually because of some change in an environment. I just said, look, it's obvious that it's going to benefit, and I'll buy the stock, and then I'll do the research afterwards, to make sure that there's nothing wrong with the accounts, nothing wrong with the management,
Right.
that sort of thing. But and actually, on the short side, it would often be extremely quick. My record was about, I think the management had stood up for about 10 seconds. And I texted the office and said, this is, it was, just comical.
Yeah.
And yeah, obviously it wasn't 10 seconds of work. There was
Right.
work done to follow up, but it was just that, you got very, very high conviction very quickly.
Yeah,
But
sometimes
you
you
look
get
for,
yeah, you just get an insight like that, right? Like the company management team that you spoke of, or maybe, and I don't know, short stocks, but you maybe like you got that, you just had an insight, and sometimes that insight just comes at it can come at any moment, and then all of a sudden it crystallizes all of the work that you've done previously. And so it's like a light bulb moment, and so that
yeah.
sometimes can happen, and sometimes honestly those are the best ideas.
Yeah, I think they usually are. I always think the simplest ideas are always the ones that
Right.
have made the most money. Yeah.
That's
But
been my experience.
you look forward and visualize the company in 10 years, which I think is a very, very difficult thing to do. And you want to be confident or certain as you can that it'll be a bigger company generating more profit. I just wondered, how do you do that? I find this very difficult because, my background was special situations. So, it's usually buying something that's crap, that's going to be perceived as a bit less crap and will go up a lot.
Yeah.
And, so I'm now trying to, look at things in a longer term environment, look at things with, more of a quality lens. And I just wondered, how do you do this? Because that visualization in a fast changing world with lots of disruption, I mean, or is it that you just choose, like established incumbents with a long runway for growth, like your Floor and Decor sort of
Mhm.
example? I mean, how do you think about what's going to happen in 10 years' time?
Yeah, I mean, it's that's the thing I've prioritized most in recent years, or really since the get go of my fund. But the two things would be durability, and then we spoke about this a few minutes ago, but capital allocation, and those are
Mm.
my best investments. I did a postmortem on my fund, recently, the first 10 years, and those have been the best investments. Have been the ones that I've felt most convicted on in terms of the durability, and then also the capital allocation that I understood. And so, looking out 10 years, I met with the management team of NVR, a home builder, and Paul Seville, the chairman of the company, made this comment like, home building hasn't changed since Jesus was a carpenter. And so, that's the type, like, and it got me thinking, like, yeah, 10 years from now, NVR is going to be building homes. And we have all sorts of reasons why you might like or not like NVR as a company. But, I think there's some fundamental tailwinds to that industry that I really like. And I think there's a shortage of housing in this country. And so if you're in the position to add supply to a supply constrained market, you're in a good spot. And when you couple that with the quality of the management team and so forth, that gives me confidence that a company like NVR is going to be around. It's hard. It's easier to use examples, but a company like Copart, that's another great company that has a sizable barrier to entry. And what they'll tell you is it's not just that it takes a lot of land. So Copart, for those of any of you probably know this company, Steve, but if you don't, or if your listeners don't, it's basically they own junkyards, they own salvage yards, and they will take a cut of basically when you get in a car wreck, you send your car to one of maybe two places in this country, and those are essentially junkyards that will auction your car to a wholesaler or a dismantler or somebody else that wants to buy the car for scraps or to try to rebuild it, resell it. And so these are like platform companies, but they own big. They're very capex heavy. They own a lot of land, or they have to lease a lot of land. In Copart's case, they own the land, and so that's a barrier to entry, and it's really hard. The thing that's interesting about that business is the permitting process is extremely difficult. It's hard to set up a new a new junkyard. Nobody wants one in their backyard, right? And so that's like a barrier to entry that gives me confidence that that business has a lot of staying power. And so I try to look for things like that where I can wrap my head around what the company does, what their barrier to entry is, or what sort of competitive advantage they have. And then just ask yourself the simple question: do I think this company's going to look similar in 10 years? Some of them, they're hard. I mean, Google's the one exception where that is more difficult to judge. But I try to place emphasis on companies like Floor Décor or like a Copart that have that durability and predictability to their business.
But I mean, I would look at Copart through a slightly different lens. It's not a stock I'm familiar with, but I would say in 10 years' time, we'll be that much closer to the adoption of automated vehicles. So if Google is as smart as we think they are, maybe they'll have some breakthrough with Waymo, and automated vehicles will become a thing, in which case there'll be much fewer car wrecks, one would imagine. And that could, Copart in 10 years' time, we could be thinking about Copart as having a market that's 50% smaller or 70% smaller. I find this, looking out a long way, very difficult. Am I just too nervous
No,
and too things don't change that much?
no, I think that's right. I mean, in terms of just it's difficult to look out that far. I think finding companies. I mean, there are sometimes, and I'm not recommending Copart. I'm not recommending any stocks, of course, but certainly I'm not recommending Copart as a stock. I'm just saying that as a business, I think it has durability. And one of the things that I think is interesting is, there's oftentimes the narrative doesn't necessarily jive with reality. And one of the things that's interesting about, and this could, I would throw like fossil fuels in general in that category, where we need more energy in 10 years. We're trying to electrify more and more things. We're trying to electrify our vehicle fleet, and these things take energy, and energy has to be produced from somewhere. And so even though renewables are gaining share, we're still going to need a lot of fossil fuels. So sometimes narrative
Sure.
doesn't match up with the reality. With Copart, an interesting stat there is there are 1.1 billion vehicles on the road, and that's up from, I think, 850 million a decade ago. And those are not EVs; those are gas-powered vehicles. And so we actually have more ICE vehicles, internal combustion engine vehicles, now than we did a decade ago. Even though EVs have obviously dramatically taken market share or are rapidly growing over the last decade. And so, as the world continues to develop, I think we'll see more and more vehicles. And every year that goes by, you have in this country 15 or 16 million new ICE vehicles on the road, and those vehicles have a long lifespan. So I think there's a longer lifespan there, in particular when it comes to those types of things. But yeah, there's always a risk to businesses. I mean, Geico itself could be disrupted by the things that you speak of. And it's hard to look out 30 years and be sure of any business, which is why you have to pay a price that, hopefully you get a lot of the cash up front, so you don't have to rely too much on that 30-year terminal multiple.
No, sure. And I mean, Geico for sure will be disrupted by this. I think that's a certainty. I mean, obviously I'm sitting in Europe and you're sitting in America, and there's a very different attitude to the car. But there was on the radio this morning, I was listening, and they said that London is the slowest city in the world to drive a car in, and I can be quite sure that as soon as AVs are remotely practical, you won't be able to drive your car in central London, which is, I don't drive an EV. I bought myself a nice V8 engine car because I thought I'm not going to be able to drive one for that much longer, and I like the sound of it.
Yeah.
But my children sort of slightly disapproved. But you went to China, and I was quite jealous that you went to China with Connor Leonard, who used to run a family office, and Jake Rosser of Coho Capital. I know they're both friends of yours. And I thought that must have been a fantastic trip. Tell me, what did you learn from visiting China, and what did you learn from doing that trip with them?
Oh, it was a great trip. Yeah, we visited some companies. We met with a variety of different people and some investors there, and just did some tourist stuff and learned about the culture a little bit, and sat in coffee shops. It was a great trip. I think it was a 9-day trip. That was also coming up on 6 years ago. Yeah, what's interesting about that is it coincided with that was a pivotal year, because later that year was when Xi Jinping essentially rewrote the constitution to allow himself to extend his term past the typical 2 terms. Over there, they do 5-year terms. And so that was the end of his first 5-year term. And of course, a lot has changed in China since then, unfortunately, in terms of, I believe it's moved more in the direction of, I should say it's moved away from the trend, which I was hoping it would continue on, which was more of I don't want to call it a democratic trend, but a little bit more liberal in terms of freedom, not liberal conservative, but liberal in terms of moving towards more capitalistic, moving towards more free market reforms and things like that. And I think some of those things have been reversed. And the thing about the party is, they want power above everything else, including the health of the economy in the short run. They need the health of the economy in the long run, because otherwise you end up in revolt, right? But in the short run, if you have to prioritize one or the other, it's going to be power, because you can always fix the economy later. And so that's been a problem for them. But yeah, one of the things I learned there is just what a great country it is, and just the people were terrific. Beijing is like Silicon Valley. I mean, we met with all these different venture capitalists, and this is a different time period. I'm not sure what it's like there now, but just ultra competitive. Everyone's starting a new business, a new venture. So one of the things I learned is, China's going to be a difficult place to invest in. Honestly, it's just there's so much there's so much happening there. There's so many new companies getting started up, and it's going to be very difficult to pick the winners. So the broad takeaway for me is, I think there's a few companies that probably have good competitive positions there, but outside of that, I don't personally feel equipped to be able to predict who's going to emerge from the sea of growth that I think we'll continue to experience over the coming decades there. But I'm keeping an eye on it. I think it's a great country, and there's a lot of I think there's a bright future there, but a lot of capital, a lot of competition, and it's going to be great for the people, great for the economy. But as an investor, you really need to pick your spots carefully there, I think.
You don't really invest outside America, do you?
I don't right now. I mean, all of my investments are North American. We have a few Canadian investments, but yeah, outside of U.S. and Canada, that's where 100% of my investments are currently. I am looking at other areas. Japan is an area that'll probably be my next trip, probably later in 2024, to visit that country, because I do think there are a lot of interesting things happening there when it comes to sort of the opposite, where a lot of we're discouraging buybacks in America. They're encouraging. They're telling their companies to buy back shares. There's too much capital locked up on corporate balance sheets in Japan, and that stifles the economic growth, right? You have trapped capital. That capital should be returned to exiting shareholders, who can then invest it elsewhere, put it in a bank. The bank can lend it out. That's how the flow. You want to increase the velocity of money, and that's what Japan is doing. And so I think releasing some of that trapped capital is going to really help ignite some economic growth there. And it's a much less competitive environment than China and other places. So I think there's some interesting things going on at a macro level in Japan. And then when you couple that with the incredible valuations that I see there, it's that's one area that I'm looking at. I've been looking there for a while, but I haven't done anything there. But yeah, I'm willing to invest outside of the U.S.
Yeah, Japan's an interesting place. I mean, whenever I've looked at it in the past, when I was a professional investor, when you meet management, you just put your head in your hands. I remember, so I went to meet the management of one company. It was a competitor of the company that I had an interest in, and I asked him why he wasn't putting his prices up, and he said, "Oh, customers know like." There was everybody else was putting their prices up, and he just didn't want to do it, and it was just bizarre.
Yeah.
Now, the tool that I use, the AI tool I use to transcribe my podcast, tells me how much it does it in blocks. It tells me how many blocks are me and how many blocks are the guest. Now, I've had a couple of guests I didn't really enjoy, so I tend to speak more. And then I've had guests like you or Chris Paviz, where we've had a lot of discussion and arguments. And one of the arguments, too strong a word, but one of the disagreements we had, Chris Paviz, was on location, because Chris was saying, look, I'm in the Blue Ridge Mountains. It's fantastic. It's peaceful. It's quiet. I'm away from the noise. I'm away from the hubbub. And that allows me to make better decisions. And I said, man, no company, other one that's located in the Blue Ridge Mountains, comes to see you. Whereas if you're in London or in New York, every company in the world is coming through that financial capital. And that allows you to build up a picture of what's actually happening in the real world, because you can talk to the companies. And I said, my belief is that if you're in the center, you can switch the noise off. When you want to do some work and study a company, you don't need to have the noise on. What's it like in Raleigh? Is it the same as the Blue Ridge Mountains? How do you feel about this?
Well, I kind of envy Chris, because I'm in the same state as he is, North Carolina, and the Blue Ridge Mountains are one of my favorite places to go. I take my family up there every year, and we go, we go hiking in the Blue Ridge Mountains, and we stay in a town called Blowing Rock, and it's just beautiful up there. So yeah, I can see that is an ideal setting for getting some quiet reading done and some research. But yeah, I think for me, I like Raleigh because it is a mid-sized U.S. city. It's not a big city, but there's plenty of things happening here, and I personally have, you know, I I don't know if it's maybe you could call this like a little bit of FOMO or something, but I love going to the mountains and being secluded for a week or maybe 4 or 5 days. But then I'm kind of like, all right, I want to get back to sort of where there's a little bit more vibrance happening and things are happening. Be around my neighbors, be around more people. So I'm a little bit more of a people person in that regard. But I do think there is something to the idea that you need a spot, and you could do this in New York, you could do this in London, and you don't have to use that as an excuse that you can't think in those cities. You just have to carve out time to do that thinking if that's important to you, and so you can do that anywhere in the world. I think for me, I like living here. I chose this spot more for family reasons and that's just where I landed, but it wasn't a strategic idea from an investment standpoint. But yeah, Raleigh's a great place to live. It's a great place to run my business, to do good thinking. And then also like to hop on a plane. If I want to go to New York, I can be there in a few hours. So it's like, if I go to visit companies, companies for me tend to be all over. So I usually go to them. They're not coming to me for sure, but I just travel to wherever I need to travel. And, I think it's a happy medium. There's, as long as I'm relatively close to an international airport, then I can do my work and, I can sit in my office and get my reading done and kind of have the best of both worlds. So that's kind of my take on it.
I mean, your funds relatively small relative to large institutional funds. Are companies quite happy to see you? And does having a big profile, but you're quite a high profile investor, does that help?
Uh, you're being kind, Steve. I don't know how my profile is not. I don't think my profile, to the extent that I have one, it certainly doesn't get me in front of management teams. The investing blog certainly has helped network with friends and certainly has helped build my business. It hasn't helped like get me in front of managements, but I do think management teams are willing to meet with you. One thing I've been working on a lot recently with a few of the smaller investments we have, and this is sort of a broad theme that I've just sort of started to notice, is there are a lot of opportunities between. Uh, I guess the way I would describe it is like I think there's a dichotomy between large stocks and small stocks in terms of the
Yeah.
valuation. So I've been looking a lot more at small stocks just because I find them to be attractively priced. So when I'm looking at small companies, then yes, those companies are more willing to meet with me, and I do that to the extent that I can. I find that to be a valuable and useful thing to do. So I'm talking to management teams. I'm visiting with them occasionally, more on the phone call side, but I do go visit companies from time to time. Um, and I have a lot of phone calls. And yeah, like I said, on the small cap side, it's a lot easier to do that. So
Yeah.
I think the large caps were very cheap a decade ago. And, we talked about Apple at 10 times earnings. I mean, Visa was 13 or 14 times earnings. Google was under 15 times. There a lot of large companies were very cheap, and I don't think that there was that same delta between small and large stocks like there is now. And so, and this isn't really for me like a value invest. I'm not. I'm looking for companies that I think are durable, that I understand, and that offer great value, and that can come in a variety of sources. Not like necessarily a value factor, but there are a lot of quote unquote value stocks that I think are compelling currently that might not have been the case, 4, 5, 6 years ago.
I mean, I think it's quite interesting. I mean, I was, as I said, I was writing this Outlooks piece, which will be published in my Substack over the next 2 weeks. It got so long that I had to split it into two. But one of the things that was quite evident was the gap between small cap and large cap valuations in the States. I mean, more than one bank had the point, and it's. I think these sorts of things are very useful because you want to fish where the fish are, as Charlie Munger used to say.
Right.
And so if you know that there's a large cap, small cap, pricing differential, then it behoves you to look at the small caps. You've got some quite large companies, so I guess Floor Décor would be kind of mid cap for America. It's about 11 billion.
Right.
I was looking at it because it's your second largest position, I believe, and I was surprised at the valuation. It looks like, I mean, I had it down as a 50 odd PE, and I was quite surprised because I mean, we've never met before, and I'd never looked at your portfolio, so I don't know why I had the perception that you wouldn't be the sort of person that owned the 50 times PE stock. But why does that not scare you? Or are you so confident about the prospects?
Yeah, that Floor Decor is one of the exceptions to my rule of thumb of preferring all three engines working in your favor. Floor Decor, I think we're going to get a significant contribution from the growth engine, and not hyper growth. But it is butting up against that 20%. It's growing at 20 to 25%, and it is a as Peter Lynch used to say, it is a fast grower. It is a company, I just, for anyone interested, Andrew Walker and I did a podcast on Floor Decor recently, and that's probably a good way to get more details and more of my thoughts on that specific company. But it is, I don't think it trades at a 50 PE. I think the normal earning power is quite a bit cheaper than that, and that's just based on some accounting factors and just the nature of some of the deleverage that the business has experienced in the last few quarters. I think that'll sort itself out over the next year or two. But it is certainly an optically expensive looking stock regardless. But I think it's got one of the strongest moats that I've studied in a vertical that doesn't attract a lot of attention, which is flooring. But in a nutshell, Floor Decor is dominating a very fragmented space, and so they're the biggest player in retail flooring, and there are probably 13,000 mom and pop shops around the United States, and so there's a very fragmented group of small competitors that can't compete with Floor Decor because they don't have the same scale. They can't offer the same low prices. They can't offer the same selection. And that's what Floor Decor is doing. So it's kind of running the same. It's very similar business, in my view, to O'Reilly Auto Parts, where they are catering to the professional customer. They're consolidating a group of very fragmented, smaller competitors that don't have the same scale. And that white space just lasts, a long, long, long time. And then you couple that with the industry backdrop of what we spoke about earlier, which is housing. I think housing it's going to go through ups and downs, certainly, through recessions and interest rate cycles and so forth. But over the long term, over the next decade plus, I think that business is really positioned to do well, and it has a super strong moat in the industry it operates in. So.
No, it's interesting. I mean, I hadn't appreciated that I just looked at the multiple on the screen, and I
Yeah.
thought, oh,
Yeah, it's one of
because
those rare
you'd
stocks
written
where,
about Fastenal.
yeah,
And
if you look at the 10-year test of it, Steve, like once you get to study it, it might not be one that jumps out at you initially, but when you study the business and I mean, I've been to their distribution center. They have a number of them, but I've been to the one in Baltimore, which is one of their newer ones, and you just get a sense for how much of a well-oiled machine that supply chain is and how difficult flooring is. I mean, one pallet of flooring weighs over a ton, when it comes to like some of the,
yeah,
some
no,
it's heavy to
no,
move.
I mean, I can see it's I can see it's a very robust
Yeah.
company. I haven't done any work on it. I just saw the valuation was quite.
Yeah. That's one of the rare ones in the portfolio where I think that, we have a number of stocks right now that are trading at 50, I would say between 10 and 15% free cash flow yields. And that tends to be more of my sweet spot. We have a couple that are sizably above that, actually. But yeah, there tends to be, I mean, the capital return engine is something we talked about before. The buybacks are something I speak of, or something I focus on a lot. And so that's the majority of the portfolio, I would say, falls into that category. But we do have a couple that I think are going to be long-term, they have a long-term growth runway that are attractive when you look at the earnings they'll generate, years out in the future.
I mean, I used to think it was quite important to have a range of valuations within the portfolio. So, just having a portfolio of stock on single digit PEs probably wasn't going to work, because there's probably a reason why they were, there might be different reasons, but there, if the stock market decided growth was what they wanted, what people wanted, then these stocks would languish. And so I've always believed that, one of the ways to diversify your portfolio is to think about, don't have all cheap, boring, low single digit PEs, have some sex and violence in there just to give you a little bit of diversification. And I mean, do you think about that? Or you've got a very concentrated portfolio.
Yeah, that's an interesting point. I do have a variety of different diversification tests. And so these are things like, I don't want to have, I want to be cognizant of what my exposure is to things like interest rates. I don't want to have too much debt. Most of my companies don't have much debt at all. But to the extent that companies do have debt, I want to know what percentage of the portfolio has debt on the balance sheet, what that consolidated debt level is, how much of it is exposed to any one industry. So not just interest rates, but things like housing. We have some housing investments. And then also, yeah, I do think about not exactly in the way you put it, but something similar in terms of, I think in terms of categories of investments. So I have two broad categories, and one would be like my core holdings. These are companies that I think can compound value for a long period of time, and I intend to own those for a decade plus. And that could be a royalty company that takes a cut of the natural resources that it owns in the ground, and that will probably be happening 10, 20, 30 years from now. Or it could be something like Floor Décor that I think just has a sort of a better mousetrap and a huge moat in the niche that it's in. And so I think those are like the category ones that I intend to hold. And then category twos would be more of what I call value to a private buyer. And so these are stocks maybe similar to more of your special situations, but they may or may not have a traditional catalyst like most special situation investments do. But sometimes they do, but sometimes they don't. They're just cheap. And so I tend to look for stocks that are the value to a private buyer is significantly above where I think the stock is trading at. And so we have a few of those as well. And so, yeah, I like to have some diversification in those categories, but I don't like from a top-down basis try to allocate to those. I just look at the opportunities. And so I just sort of explicitly outline where my portfolio allocations go. But yeah, I do think about those. And then also in terms of the three engines, I want to have some of the portfolio weighted towards, the capital return engine. Ideally have most of the portfolio in value stocks. I think the base rate for value as a factor is pretty evident over the long run. It hasn't worked in the last decade or so, but I do think if I had to pick one factor above everything else, it would be value as measured by, enterprise value to EBIT or even PE or something like that. But, I don't make investments on a basket basis on that, but that is something I keep in mind.
Interesting. Now, you talked about a similarity between cross-country running and investment. Both have long feedback loops. And I want to ask you about this because you run 50 plus miles a week, which is like more miles than I do in the car, would you believe? In a week.
London, that's probably.
And it may surprise you. I took up running, in my advanced years. I took up running in COVID because I just needed to get some exercise, and it was like sheer desperation. And I hadn't run since I was at school, and when we were at school, we either used to run around the field, the playing fields, the rugby pitches, or the long route was outside. And when we did the outside, a few of us used to stop in the tenement and have a cigarette, and we used to miss out a lap, which shows my age. But what's the similarity between investing and running? What's the long feedback loops?
Yeah, well, the long feedback loop is, in both running and investing. And you could say running, but it's fitness in general, right? Or you could even say like healthy lifestyle, healthy eating. If you're trying to improve your health or your fitness, it takes a long time, and there's no quick. It's kind of a topical conversation right now with the some of the therapeutics and the drugs that have come out in the last year that have sort of hit the headlines and stuff, which I'm not a fan of any quick fix to health. I think it's a long feedback loop, meaning you have to put in the time, you have to eat healthy. It's common sense. It's simple stuff. So with both health and investing, it's very common sense stuff, right? Consume fewer calories than you burn if you want to lose weight. Eat healthy. To me, that's, I eat a lot. I try to, mostly plants, eat food, mostly plants type of thing. And nothing against meat. I eat meat too, but I just like, it's pretty simple to get nutrient dense food, healthy eating. It's common sense. There's no like magic. There's way too much complexity. There's always a fad going on, whether it's like intermittent fasting or things like, and I hate to call that a fad, but I do think like you just need to do common sense things, eat healthy, exercise, and consistently stick to that program. And you'll notice improvements over a long period of time, right? Over a period of weeks, months, years. And that's the same with investing, is that you can't force things. You can't make money tomorrow, right? You have to put in the work today. It's like Jeff Bezos said, like somebody said, "Hey, great quarter, Jeff." And he's like, "Well, that great quarter happened 3, 4, 5, 6, 7 years ago." Right. So it's a process that takes time. And so that's sort of the metaphor there, is the long feedback loop is with both running and investing. It's a long game. You have to put in consistent work day after day, and it compounds over time.
Interesting. So I normally conclude by asking people to recommend a book, but we started off by talking about Peter Cundiff's book and John Neff's book. The John Neff and Investing I really, really enjoyed. And I was looking at that because I was trying to understand how people invested in an era of inflation. Yes. But is there another book that you would like to recommend?
Yeah, those are two great books. Another one that we spoke of that I would recommend would be Built from Scratch. And so that is a book about, I referenced it earlier, but it's about Home Depot. And, we touched on Floor Décor. That would be a book that, for anyone interested in Floor Décor, the Floor Décor CEO came from Home Depot. He spent 20 plus years, 2 decades running Home Depot, or he started at the floor and worked his way up to executive VP of operations. And he was at the store when it had, or at the company when it had 16 stores, and he left when it had 2,000 stores. And so they're kind of running the same playbook at Floor Décor in a similar way. And so I think that's a great book for anyone interested in that company. And it's a fun read. I mean, it talks about the origin story and how they raised capital and how competitive it was and how difficult it was and the growing pains that they experienced. So it's a really good sort of a case study on Home Depot and how difficult the retail business is. But that's another one that I would recommend.
Okay, well, I'll put those 3 books in the show notes. Peter Cundiff has been recommended before. I've recommended John Neff, but no guest has. And certainly Built from Scratch. I'll need to read that. I've got a pile of books. I actually photographed a pile of books at the start of the year.
I think I saw that. I thought, yeah.
How am I going to get through all these things? I mean, it's just, I saw people photographing the books that they'd read in the last year. And I thought, how do you manage to do that? Because I read the book and I put it on the shelf. I mean, it just so happened that I had a pile of books that I was working on for the podcast that I was in a separate pile. And then I had another set of books that I just put on the bookshelf. So I just put them together. But probably the last thing I need is to add to my pile. But I kind of feel that, you can't have too many books to read, right? That's
books are, for me, books are kind of like, we talk about the watch list of companies I want to study, and it just keeps growing and growing and growing. I buy books on Amazon all the time. I mean, multiple times a week, I have books coming to my house, and I'm building up my own library, and I just can't get to them as fast. And so I have a little system to try to rank those as well. But the reality for me, this might be different than many investors, but that you speak to. I know everybody talked about reading books. I think I read fewer books than most of the people, at least if you look at their Twitter profiles. I mean, I do have a couple of friends that I know for a fact they're reading, 50 books a year plus. And
oh my goodness, that's amazing.
Like a book a week.
That's really difficult to do, though.
It's hard to do. For me, I always think of it in terms of an opportunity cost. If I'm going to read this book, that's time away from reading about this company that I really want to read at. And, as I'm reading the book, I keep looking at the corner of my desk, looking at this annual report that's just like calling my name, and I want to like dive into that. And so I think as an investor, there's no right way to do it. Warren Buffett, I don't think reads a lot of books from what I can tell. Now, that might sound shocking. I think he reads books, but he reads an enormous volume of financial statements, right? And or reports, hundreds and hundreds a year, he says, right? So I think that's where he's spending his time. And he even joked at an annual meeting recently that, his bridge playing, he plays like 15 or 20 hours of bridge a week online. He says, yeah, my bridge playing really cuts into my book reading. And so I get the sense that he doesn't read, he's not reading a book a week. I would bet that. And
I'm sure he's not.
Now, Charlie Munger, on the other hand, of course, is famous for, like he's legs with a book sticking out, as his kids used to say. Like he's reading a book all the time. And so there's different ways to do it. You get a different perspective from reading a book. But I find most of my reading tends to be like company specific financials, trying to get at the crux of the thing. But yeah, books can be very valuable. And I do read a fair number of them, but just not as many as I read, annual reports, I guess. So
it's fine, because when I was at the hedge funds, I couldn't pick up a book at the end of the day. I'd read so much every day, and not just annual reports, but research coming in from the banks and reading up about companies and trade magazines. My eyes couldn't have managed it. And my wife used to go mad. She actually bought me a Kindle, because when we went on holiday, I used to pack it with the suitcase with all these hardback books. So the suitcase weighed a ton. And she bought me a Kindle because it was just unreasonable. Because the only time I could read was when I got on holiday. But listen, I really enjoyed talking to you, John. I really appreciate your taking the time. Where can people find you if they want to get in touch with you?
Yeah, Twitter's always a good spot to find me. John Huber 72 is where you can find me on Twitter. And then from there, you can find my firm's website, sabercapitalmgt.com. And then I write a blog called Base Hit Investing. And, you can search for that and find me there as well. And I do a lot of writing online. So yeah, always happy to engage with anyone that has interesting thoughts or questions or the like. So, but yeah, I appreciate the time, Steve. It's always a fun conversation, and enjoyed it very much.
Thank you so much.
All right.
John is an extremely thoughtful investor, and his portfolio is an interesting one. I shall post the 13F disclosures in the episode webpage on my website, behindthebalancesheet.com, where you can also access a transcript of the show. I love that house building quote. Home building has barely changed since Jesus was a carpenter. But I do think that more and more companies today are being disrupted. I'm quite interested that John seems sanguine about Google. My perception of the risk has changed significantly in the last 18 months. And I'm curious about Floor Décor, where the valuation looks quite steep to me, although obviously there is a clear runway for growth. I'll put that valuation table in the show notes. I'm absolutely fascinated by this idea of a 10-year or even longer holding period. And I'm going to return to this subject both on this podcast and in my Substack. Thank you for listening. Please don't forget to subscribe or follow, and please, can you leave a 5-star rating on Apple Podcasts or Spotify? It really helps. Let's spread the word. Thank you for listening. I'm Steve Clapham. That was the Behind the Balance Sheet podcast. Please don't forget to subscribe to the YouTube channel. And why not visit our website, behindthebalancesheet.com, where you can find the show notes and lots of other videos which can help you on your investing journey. Thank you for watching.